House prices have increased more rapidly than household incomes, with the exception of Northern Ireland, where they have largely aligned within incomes since 2013. Mortgage rates are unpredictable and, well, inflation, well, it's hiding the truth. Let's quickly break down this graph, because understanding this might change how you see every headline you read about inflation, especially when it comes to property. CPI, the Consumer Price Index, that light blue line you see there, is the headline rate of inflation you see on the news all the time. As of March, it's at 2.6%. As of April, it went up to 3.5%. It measures the average change in prices for goods and services like, food, fuel, transport, clothing. But here's the problem with it. It doesn't include the cost of owning and living in a home. Let's be honest, is the single biggest expense most of us have, other than maybe nursery fees. That's where CPIH comes in, the dark blue line. That's at 3.4%. The H stands for housing, and it includes a measure called OOH, owner occupiers housing cost. Dark red line on the graph sitting at the incredible 7.2%. This is an attempt to capture what it feels like to own a home by estimating how much you pay to rent a similar property. But even CPIH doesn't track actual house prices or mortgage payments, amazingly. Instead, it uses something called imputed rent. Basically, what you might pay to rent the home you already own. It's a soft estimate, not a reflection of real mortgage costs or deposit hurdles. Then we've got OOH on its own, that dark red line I mentioned, sitting at 7.2%, which tries to isolate just those housing costs. So maintenance, stamp duty, insurance, and again, this imputed rent. But none of these actually include house prices or mortgage rates directly. So when interest rates go up and your mortgage suddenly doubles, which a lot of people have experienced, that isn't showing in CPI inflation. So when the Bank of England says inflation is under control at 2.3% or 3.4% or whatever the figure is at that moment, it's rubbish. What they really mean is food and clothes have stopped rising. But your cost of living, if you're buying a home, may still be going through the roof. Owner-occupiers' housing inflation is at 7.2%, for goodness sake. So it is housing costs that are killing our standard of living. But behind all of this is someone that is winning. In this video, I'm going to expose how the UK housing market is being quietly rigged and who's doing it, which I know sounds dramatic, but I think what you'll find watching this is it's the currents shifting markets that are often fueled by a very small percentage of people or really companies that are just protecting their self-interest, and that then is influencing governments and how rules of the game are then set. I'll also get into what I think you can do to protect yourself, because in the right circumstances, home ownership is of course a really great thing. Property investing, of course, can also be a really great investment. And if you don't already know me and you're wondering, well, why the hell you should consider my opinion on this topic? Well, I founded British Home Buyers, a UK-wide home buying company, and British Home Sellers, a nationwide estate agency, back in 2013. And over the years, those companies have been involved with over 4,000 towards 5,000 transactions, pushing towards £5 billion of property. So understanding all of this is really my day job. So let's get into the illusion of growth, because Halifax tells us house prices have increased 2.5% year on year so far. Nationwide tell us house prices have increased 3.5% year on year so far. But house prices adjusted for inflation have increased 0.4% over the last 12 months, having dropped 16% over 2022 and 2023. We're living through a silent crash hidden by inflation. And for first-time buyers, this illusion is financially devastating. So who is winning? So if regular buyers are losing, who's winning? Well, big players like BlackRock, Lloyds Legal General, these aren't just landlords entering the market. They're building empires. BlackRock is on an asset buying spree in picking up undervalued UK property. Lloyds has declared since 2021 that it wants to become the UK's largest landlord. They're snapping up homes, often directly from developers, in bulk, so entire blocks that never even get listed online. They get discounts, they get economies of scale, and government incentives. So for instance, like paying commercial stamp duty rates rather than residential rates you and I would pay. The right part of this image is commercial rates. So they pay 5% essentially, whereas the left is standard rates. And you can see as an investor, you'd pay 5% higher rate of stamp duty on top of the standard stamp duty. So far more than commercial rates. BlackRock is even buying into brick manufacturers, literally controlling the building blocks of UK housing. They are even buying up railway arches, more than 5,000 of them that have the scope of, if they're not already, being developed underneath as commercial space. So you have to understand, these big corporates, they don't just buy homes, they are buying the system, which then influences and molds how the market develops, how the rules of the game are set. It ultimately controls the price of home ownership. So how does inflation help them? Now, here's where it gets clever for them. Inflation, which hurts your savings, actually helps these players. They borrow billions to buy assets. Inflation then erodes the value of that debt, but not the rent they collect from you. So here's a visual that clearly illustrates how inflation erodes the real value of a loan over time. So that dashed line shows the nominal value of the loan, £100 million, which doesn't change. The solid line shows the real value of that loan when adjusted for a 5% annual inflation rate. So it dropped to around £77 million 5 years after taking the £100 million loan. This helps explain why inflation benefits borrowers. The debt remains the same in nominal terms, but its real burden gets lighter over time. That is why they want yield, not necessarily capital gains. With the right yield, inflation works in their favour. And meanwhile, inflation pushes house prices up nominally, even when value is flatlining or even falling. It's a trick of the data. Doesn't matter, house prices are flat relative to inflation, and you're the one paying for it through rent or inflated purchase prices. So let's get into the danger of 100% mortgages. 100% mortgages are back, aimed at first-time buyers, but what it really means is more liquidity flooding the system, which props up house prices. As buy-to-let landlords exit, many of those smaller homes are being snapped up by not your average families, but by corporates or highly leveraged buyers enticed by low deposit deals. So for a moment, let's step back for a second and imagine this. What if for the past 50 years, the rules were different? You could only borrow 2 times your household income. You needed a minimum of a 25 deposit no matter what. And investors and corporations paid 10% stamp duty surcharge. We'd still have the same housing shortage, the same race to get onto the property ladder, and the same emotional weight tied to owning a home. But the key difference, with less money in the system, house prices would be lower. It wouldn't be easier to buy necessarily, it would just be cheaper. Because house prices don't just reflect supply and demand of property, they reflect how much money is chasing that supply. That's why when banks relax lending criteria, when governments offer help to buy or 100% mortgages, when interest rates fall or QE pumps trillions into the economy, it adds fuel to the market. It's not adding more homes, just more money chasing the same homes. That's why your parents could buy a 3-bed semi-detached house on one income, and why today even 2 professionals struggle despite earning far more. Liquidity inflates prices, but it doesn't ease the pressure or fix the system. It just makes it look like we're doing something, while in reality kicking the problem further down the road. So what can you do to protect yourself through this? How do you win in this rigged game? The average dividend yield if you own shares in a slice of all UK banks is 4.25%. So if you invested £100,000 in those banks, in those companies, you'd on average make £4,250 per year return. The average savings in an instant access savings account is 2.41%. So you'd make on average £2,410 per year in interest. So I ask you the question, who is winning there? The people that own the bank or the people that use the bank? Do you think those that own the bank want you to borrow less or more money? Who do you think is then influencing policy, influencing government? The way to protect yourself is to play the same game BlackRock and other big corporates do. Focus on buying assets. Why have 100k in the bank when you can invest it responsibly into assets? But remember, that doesn't mean any assets. BlackRock won't buy any property or any company. Make sure you don't overpay if you're house hunting. Focus on buying property in growth areas and or a property you can add value to over time. Use your sweat equity to do it. If you're an investor, stop chasing capital growth, focus on yield, resilience and adding value. Inflation can work for you, but only if your rent covers your debt and then some. Or if none of that suits you, why not consider low-cost index funds, buying gold or silver, dare I say it, Bitcoin? A lot of you comment in my videos about Bitcoin. So here's a comparison of £100,000 investment made 5 years ago to today. You can see from the graph, Bitcoin grew approximately 6.2 times, so 100k would have turned into £620,000. UK property, assuming a 75% mortgage, so 4 times leverage, turned £100,000 deposit into £205,000 of equity based on 35% house price growth. So look, personally, I feel Bitcoin is high risk. Maybe comment below if you think I'm wrong on that. I personally allocate a small percentage into Bitcoin in my investments. Comment what you think. I'll see you in the next video up here.